Well, I think the ECB, my personal view is that the forward guidance that they gave on interest rates back at the summer meeting to keep rates on hold until after summer next year is a policy mistake. And I'm in the camp that the ECB needs to start setting up to raise rates before that. And so I think what the market will be looking for today is just some subtleties in the language that they use to acknowledge the strength that there is underlying the economy.
It's very subtle, isn't it, when it happens, when they flag up a change? It's like one or two words.
I mean, if you look at it, growth in Europe is quite strong. Inflation is at target. They've managed to get some weakness back into the euro from where we were earlier on in the year. I think there are reasons to be thinking that the ECB needs to start doing some very slight setup.
Yeah, and I hope you're right from a wage point of view as well, because I know that uncontained inflation is the enemy of financial markets, but modest wage inflation is something that will be very positive for a whole host of people and a whole host of European economies as well. It's beginning to come through, isn't it? The UK wage figures, and you can reference the BOE if you want as well. A lot of interesting wage deals. Mr. O'Leary's issues with the union as well. It's coming through. It's seeping through. This is a good thing or a bad thing?
A good thing, I think. I think the goal has got to be to get some policy normalisation before we head into the next downturn. And if you look at the ECB's case, they've got quite a big hill to climb. You've got to you'd hope that European rates would be above 1% at the beginning of the next downturn. That's probably 25 basis point hikes.
They're out of time, aren't they? We keep hearing about some form of a rolling over in financial conditions, 2019, 2020. The ECB program, if you think about starting to exit from extraordinary stimulus, they're out of time. There is no run rate to be able to get out of this crisis that they've been in.
I agree. I think that's why I think the ECB is likely to deviate from its forward guidance. I think they'll be looking to get the end of QE out the way in December, and I think Q2, the market's going to...
See, I don't even think that's possible, because if you deviate too far, then you set a rocket across very fragile confidence still here in Europe. How aggressively could you fundamentally hike that rate without having markets sell off aggressively? I mean, look at Italy. We're looking at the hub of where the activity has been in recent weeks. Any deviation would put, what, 50 basis points, 100 basis points back into that yield?
Well, I mean, the benefits of the 40 basis points of cuts to a negative rate were pretty marginal and questionable anyway. So they can quite easily take back that 40 basis points, I think, without having any serious impact on the economy.
What should our viewers do? There you go. Big open question.
If you look at what the market's pricing, it's pricing about a 30% probability of a hike in the second half of next year. I think there's a good probability that the ECB's got to do at least 25 basis points in that time.
And the way to take advantage of that change in communication, if and when it happens?
Is probably positioning in the Eurobond strip, for example, like 3-month interest rate futures.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.